Mark Reynolds is sitting at his kitchen table in April with a half-empty coffee mug, a laptop, and the quiet satisfaction of watching his tax bill fall. He is 34 years old, an operations manager in Ohio, earning $92,000 a year, and for the first time in his life, he feels like he has found the adult version of a cheat code. His tax software shows the number clearly. Because Mark put money into his traditional 401k, his taxable income dropped. His federal tax bill dropped. The money did not vanish into a new truck, a vacation, or a credit card balance. It went into a low-cost S&P 500 index fund inside his retirement account. He did not try to pick the next hot stock. He did not pay a financial advisor 1.5% a year. He did not leave his savings in a checking account earning almost nothing. He maxed out his 401k, bought the market, and got an immediate tax break. To Mark, this feels disciplined because it is disciplined. Across town, Elena Brooks is looking at a very different screen. Elena is 31, a physical therapist earning $78,000 a year. She just moved $7,000 into a Roth IRA. Same basic investment idea, broad index fund, low fees, long time horizon. But when she enters the Roth contribution into her tax software, nothing exciting happens. No deduction, no instant tax refund, no little dopamine hit from watching her taxable income shrink. Her friends at work tell her she is missing the bigger 401k limit. One of them says, "Why would you pay taxes now if the government is willing to let you delay them?" But Elena likes the trade. She pays the tax up front, the money goes into the Roth, and if she follows the rules, every dollar of growth can come out tax-free decades later. That phrase is powerful, tax-free. It sounds cleaner than tax-deferred. It sounds safer than, "we will figure it out in retirement." It sounds like she has locked the IRS out of that account forever. And this is what makes the debate so tricky. Mark looks smart, Elena looks smart, and both of them are doing the rare thing most people never do. They are saving real money. They are using tax-advantaged accounts. They are avoiding expensive funds. They are not treating retirement like something their future selves will magically solve. They are both buying the same broad market. They are both thinking long-term. They are both making decisions that are miles better than doing nothing. But they are also both looking at the part of the math that feels best. Mark sees the deduction. He sees the tax bill shrink right now. He sees that every $10,000 he puts into a traditional 401k can save him about $2,200 in federal income tax if he is in the 22% marginal bracket. That feels like winning immediately. But the tax bill did not disappear. It moved. Every dollar in that traditional 401k is still carrying a future claim from the IRS. If Mark retires with Social Security, maybe rental income, maybe a small pension, maybe large required minimum distributions later in life, his retirement tax bracket may not be as low as he casually assumes. He may be avoiding a 22% tax today, only to pay 24% later. Elena sees the opposite side. She sees tax-free withdrawals. She sees flexibility. She sees a retirement account that will not force required minimum distributions during her lifetime. She imagines being 65 or 70 and pulling money out without creating a tax bill. That feels like control. But Elena may be ignoring the price she paid to buy that control. If she pays taxes at 22% while she is working, and later she would have been able to withdraw retirement money at 12%, then her Roth was funded with expensive tax dollars. She prepaid a tax bill that might have been cheaper in the future. So the paradox is not that one of them is obviously right and the other is obviously wrong. The paradox is that two people can invest wisely in the same index fund for 30 years and still end up with different winners because taxes hit them at different times. Professor Wealth ran the numbers, and the first thing he noticed was that most people are asking the wrong question. They ask, should I use a 401k or a Roth IRA? But that question is too shallow. The real question is, what tax rate are you escaping, and what tax rate are you walking into? Because the account name is not the winner. The deduction is not the winner. The phrase tax-free is not the winner. The winner is the gap between your tax rate when the money goes in and your tax rate when the money comes out. And the answer changes the moment we stop comparing balances and start comparing after-tax dollars. Start with Mark Reynolds, because Mark's win is easy to see. Mark earns $92,000 a year. Under a simple 2025 assumption, he is in the 22% federal marginal bracket. He contributes the maximum employee amount to his traditional 401k, $23,500, because he is under 50. That one decision avoids about $5,170 in federal income tax this year. So Mark does not feel like he gave up $23,500. He feels like he gave up about $18,330 because the government effectively absorbed the other $5,170 through a lower tax bill. This is why traditional 401k contributions feel so powerful. His paycheck falls by less than the contribution. His tax software rewards him immediately. His taxable income drops, and the full $23,500 goes into the market. If that $23,500 grows at 7% a year for 30 years, it becomes about $178,900 before taxes. That is the visible number, and visible numbers are persuasive. Mark opens his account and sees the whole balance. He sees compounding on pre-tax dollars. He sees a bigger contribution limit than an IRA. He sees a lower tax bill in April. Every emotional signal tells him he made the obvious choice. But the 401k balance is not fully Mark's. Part of it belongs to future taxes. If Mark withdraws that $178,900 in retirement at a 12% marginal tax rate, he keeps about $157,400. If he withdraws it at a 22% rate, he keeps about $139,500. If his future marginal rate is 24%, he keeps about $136,000. Same contribution, same index fund, same 30 years, same 7% return, but the spendable result changes by more than $21,000 depending only on the tax rate at withdrawal. That is the part Mark cannot see at the kitchen table in April. His 401k is not automatically the winner. It is a bet, a very reasonable bet in many cases, but still a bet that his tax rate later will be lower than his tax rate today. Now look at Elena. Elena Brooks earns $78,000 a year. She contributes $7,000 to a Roth IRA. Under our simplified assumption, she is also in the 22% federal marginal bracket. Her contribution does not lower her tax bill this year. To put $7,000 into the Roth, she first has to earn enough money to pay the tax. At a 22% rate, she needs about $8,974 of pre-tax income. The government takes about $1,974 now, and $7,000 lands in the Roth IRA. If that $7,000 compounds at 7% for 30 years, it becomes about $53,300, and if the withdrawal is qualified, that $53,300 comes out tax-free. That phrase has enormous psychological power. Tax-free. It sounds clean. It sounds protected. It sounds like Elena has removed uncertainty from the future. No tax bill on qualified withdrawals. No required minimum distributions from her Roth IRA during her lifetime. No surprise tax on the growth after decades of compounding. But tax-free is incomplete math if we ignore the tax she already paid. Elena did not avoid taxes. She prepaid them, and that means we cannot fairly compare Mark's $23,500 traditional contribution with Elena's $7,000 Roth contribution and declare the larger balance the winner. That mixes two different issues, contribution limits and tax treatment. To compare tax treatment, we need to start with the same pre-tax dollars. Take Elena's $8,974 of pre-tax income. She pays 22% now, leaving about $7,000 to invest in the Roth. After 30 years at 7%, she has about $53,300 spendable. Mark takes that same $8,974 and puts it into a traditional 401k. He pays no tax up front. After 30 years at 7%, it grows to about $68,300 before tax. If Mark withdraws it at 22%, he keeps about $53,300, almost identical. That is the part most Roth versus 401k arguments miss. If the tax rate going in is the same as the tax rate coming out, and you compare the same pre-tax dollars, the math mostly cancels out. Elena wins only when Mark's future tax rate is higher than her current tax rate. Mark wins when his future tax rate is lower than his current tax rate. Tax-free is valuable, but it is not magic. It is prepaid tax. Now, make it even cleaner. Use $10,000 of pre-tax income. Same person, same investment, same 30 years, same 7% annual return. Scenario 1. 22% tax rate today, 12% tax rate in retirement. The Roth path pays tax immediately. 22% of $10,000 is $2,200, so $7,800 gets invested. After 30 years at 7%, that becomes about $59,400, and qualified Roth withdrawals are tax-free. The traditional path invests the full $10,000. After 30 years, it becomes about $76,100 before tax. Then, the retiree pays 12% on withdrawal and keeps about $67,000. In this scenario, the traditional 401k wins by about $7,600 on the same starting dollars. That win comes from the bracket gap. Deduct at 22%, withdraw at 12%. The larger pre-tax amount compounds for decades, and then the tax is paid later at a cheaper rate. Here, Mark's April deduction was not a trap, it was the correct move. Scenario 2, 22% today, 22% in retirement. The Roth still pays tax first, invests $7,800, and ends with about $59,400 spendable. The traditional account still invests $10,000, grows to about $76,100, then pays 22% in retirement, leaving about $59,400. This is where account balances fool people. Mark sees $76,100. Elena sees $59,400. Mark feels richer, but Mark's balance still has the IRS inside it. Elena's does not. People compare statements because statements are visible. Future taxes are invisible. But if the tax rate is the same on both ends, the bigger traditional balance does not automatically mean more spendable wealth, and the Roth being tax-free does not automatically mean it won. The math cancels. Scenario 3, 22% today, 24% or higher in retirement. The Roth pays 22% now, invests $7,800, and ends with about $59,400 tax-free. The traditional account invests the full $10,000, grows to about $76,100, then pays 24% in retirement. That leaves about $57,800. If the retirement tax rate is 28%, the traditional account leaves about $54,800. Now Elena wins. At 24%, the Roth advantage is about $1,600 per $10,000 of starting pre-tax income. At 28%, the Roth advantage rises to about $4,600. This is Mark's hidden risk. He assumes retirement automatically means a lower bracket. Sometimes it does, but not always. Social Security can become partly taxable. A pension can fill the lower brackets before investment withdrawals even begin. Rental income can keep arriving. A spouse may die, pushing the survivor into single tax brackets. Large traditional 401k and IRA balances can eventually create required minimum distributions. Mark did the disciplined thing. He saved, he invested, he lowered costs, he avoided stock picking. But discipline does not erase tax timing risk. The Roth wins in that third scenario, not because Elena picked a better fund. She picked the same kind of broad index fund. It wins because she bought out the tax obligation while her rate was lower than the rate she would have faced later. Now separate a different issue that gets tangled into the same argument: contribution limits. A 401k can hold far more than a Roth IRA. Using 2025 assumptions, an under 50 worker can contribute $23,500 to a 401k, while the IRA limit is $7,000. That means Mark can shelter more dollars inside a retirement account. That is not the same question as Roth versus traditional tax treatment, but it matters in real life. And before either Mark or Elena argues about tax brackets, the first dollar usually has a simpler job: capture the employer match. Suppose Mark's employer matches 50% of contributions up to 6% of his $92,000 salary. 6% of $92,000 is $5,520. If Mark contributes that amount, his employer adds $2,760. That turns $5,520 into $8,280 immediately, before market growth, before compounding, before the Roth versus traditional debate. That is an instant 50% return on the matched dollars. Elena's Roth IRA has powerful tax-free growth, but tax-free growth usually cannot beat free employer money up front. This is why the best sequence often feels less dramatic than the online debate. People want one clean answer. 401k is better. Roth is better. Pay taxes now, pay taxes later. But money decisions usually work better when they are ordered by incentives, not slogans. First, contribute enough to the 401k to get the full employer match, because free matching money changes the equation. Second, if eligible, consider maxing the Roth IRA to build a pool of tax-free retirement money and reduce future tax uncertainty. Third, return to the 401k for additional savings, especially if your current tax bracket is meaningfully higher than the bracket you expect in retirement. And for high earners above the Roth IRA income limits, a backdoor Roth can be useful, but only if they understand the pro rata rule. Existing pre-tax IRA balances can make what looks like a clean Roth conversion partly taxable. So the answer is not traditional versus Roth. It is match first, bracket spread second, tax diversification third. The math now points to the deeper question, not which account has the better reputation, but what Mark and Elena must believe about their future tax lives for each choice to make sense. Mark Reynolds was not foolish for smiling at his kitchen table in April. He lowered his taxable income. He kept more money away from the IRS this year. He invested a serious amount in a low-cost index fund. That is responsible behavior. And Elena Brooks was not foolish for choosing the Roth IRA. She paid the tax bill up front. She bought decades of tax-free growth. She created a retirement bucket that would not turn into taxable income every time she used it. Both of them were doing something most people never get around to doing, but both were using the wrong scoreboard. Mark was staring at the deduction, as if a smaller tax bill today meant the tax disappeared forever. It did not. It moved. And if his future income stacks up through Social Security, a pension, rental income, or large required minimum distributions, that deferred tax bill may arrive when his bracket is not as low as he expected. Elena was staring at the phrase tax-free as if tax-free automatically meant cheaper. But tax-free is not free. It means the tax was prepaid, and if she pays 22% during her working years, when she could have withdrawn at 12% in retirement, she may have bought that Roth advantage with expensive dollars. That is the mechanism both of them missed. This is not 401k versus Roth IRA as a personality test. It is current marginal tax rate versus future marginal tax rate, measured in after-tax dollars. If you deduct at 22% and withdraw at 12%, the traditional 401k wins the spread. If both rates are 22%, the results are much closer than the account balances make them look. And if you pay 22% now to avoid a 24%, 28%, or higher rate later, the Roth starts gaining power. So Mark's April smile was not proof of victory, and Elena's tax-free withdrawal decades later was not proof of victory. The real winner was the person who got more of the same invested money past taxes. That is the identity shift. You stop being an account picker. You become a tax rate planner. You stop asking, which account sounds better? You start asking, where am I likely paying the lowest lifetime tax rate? And that is why the employer match still comes first. Free matching money is an immediate return before the traditional versus Roth debate even starts. After that, the sequence becomes clearer. Take the full 401k match. Use the Roth IRA if you are eligible and the bracket math supports it. Then return to the 401k for additional savings. Compare spendable retirement dollars, not account balances, not slogans, not the emotional comfort of a deduction today. If this video helped you see something you did not know was there, subscribe to Smart Money and hit the notification bell. We break down the hidden math behind the financial decisions you face every day. The best account is not chosen by slogans. It is chosen by when you want to pay taxes and what rate you are likely to pay.